Hey everyone, Steve Fernandez here with this week's edition of Market Insights. I want to talk to you about EVs and give you a little market update on the EV market. It is developing quickly, and with the global environment and what's changing in the energy markets and the US's response to that, there's a lot of developments happening right now. So before we get into the video, if you're a returning viewer or you're new to the channel, subscribe. You'll get our content every week when we release it on Fridays, so you don't want to miss those upcoming videos. I just want to look at first the most recent EV data. Not going to talk too much about it, but EV sales in January 2022, the most recent data that we have, came in 87% higher than in 2021. And that came during a month when overall vehicle sales were weak. They were down 3.8%. So on one hand, you have EV sales surging. On the other, you have overall auto sales kind of tapering off. Not surprised, because we're seeing inflation, we're seeing higher prices, and consumers are feeling a little tighter in the wallet. So not surprised that the overall market was a bit weaker there. I believe, and I expect, a lot of people expect that EV demand is going to continue to strengthen. And that's really because the pain points that consumers have are being tackled head on. First of all, the main pain point is EV charging. The government has committed verbally and taken action to adding public charging infrastructure to the US power grid. So we're now in the process, the government's now in the process of rolling out that $7.5 billion they allocated in the infrastructure bill for EV charging. And they began that in February. So we should start seeing the benefits of that spending come out in the coming years. And with 48% of respondents saying that that was a pain point, that was holding them back from buying an EV, we can expect that a lot of people that can afford EVs will probably start to consider them as viable options, especially because the other pain point, cost, is being taken care of as well. And that's not necessarily through government action. It's more because the price of gas is very high. So I say very high lightly because we don't know how high it can get. I think we're kind of at that point where we probably don't have that much more upside in gas prices. But again, it's very supply driven, and we know there's a supply problem globally right now. So at the average US price of $4.20 per gallon, I saw some data here that EVs are 3 to 6 times cheaper to drive per mile in terms of energy costs. So you can see in this chart that the Ford F-150, which hasn't really hit the market yet, this is just an estimate, the Rivian and the Tesla Model 3, they're all substantially cheaper than driving around comparable vehicles that are gas powered. So pretty dramatic when you think about that cost differential. A little over a year ago, I believe the total cost of ownership was a little bit higher for internal combustion engines, but not by much, maybe 5 to 10%. And I expect that number probably is starting to look comparable now. We won't know exactly until more data comes out, but something I'll be keeping an eye on for sure. And what's most important, at least in terms of this video, this is why I'm making this video today, is the Biden administration's move this week to invoke the Defense Production Act. So it's more of a national emergency type action. We've seen it in the past. We saw it in the Cold War. We saw it when we were rolling out vaccines. It basically gives the government a lot of control over domestic industries. And in this case, the Biden administration wants to exert control over the electric vehicle metal industry. So metals and mining, think lithium, nickel, cobalt, metals that are used to produce EV batteries. We want to secure supply on US soil so we can reduce our reliance on other countries, kind of like we're seeing now with the world's reliance on Russia and foreign powers for their oil. We don't want that for EVs as well. So it's a huge move. It's going to benefit the US battery metal and US EV metal companies the most, because the government is now willing to provide funding for research and provide funding to expand production capacity. So basically, they're going to subsidize their improvement in the expansion of their production facilities and their production capacity, which is pretty huge because if production is too low and demand remains high, prices are high. If production improves and are able to keep up with demand, prices kind of be kept in check. So this should help, first of all, reduce our reliance on other countries, but second of all, keep the prices of raw materials that go into EVs down. And that should really drive EV demand even more. So in the near term, I think that EV metal companies, commodity companies have the most to gain. I've been saying this for several months now. And yeah, if you look at what was already happening in that market, you can see that the EV metals index was already outperforming the auto manufacturers index. And I expect that to continue. So if you want to get some exposure to the EV metals, you can buy the BATT ETF, BATT. It's the Amplify and Lithium Battery ETF. I recommended it in several videos before. Reason I choose this over LIT is because it has lower exposure to China, it has more exposure to the US market. And that's what we want right now. We want exposure to the US market. There's big strides being taken to produce on our home soil. And why not be an American and buy something with US exposure more than anything? So that's going to do it for this video. I hope you like the content. If you haven't already, subscribe, and we'll talk to you next week.